Thursday, okay? We do not know yet. I'm waiting for them to give us the final decision. Then I will make an announcement, okay? Put it on the blackboard. Otherwise, just waiting for the, the announcement. So far, it just can arrange based on that time. They normally won't be changing too much unless something wrong. But you're supposed to be, I think that's the first exam of that week. So that's the week of the exam week, okay? So pretty much around there, okay? Now, let me say this again regarding to your participation, okay? I know the course is so easy. It is easy for senior, but it doesn't matter easy, not easy. Key point is that if you don't follow the class, you have to read the book multiple times, right? And your participation, because if the question is simple, exam question so simple, everybody get a 90s, 80s, then becoming sensitive, okay? If a question difficult, that's a good thing because you have a distance, so you and the other student, classmate will have bigger gap, easy to do. But if it's so simple, very close, your midterm very simple so far, and becoming sensitive. Sensitive means like a tiny point difference. You could becoming A and a B difference in your grade curve, right? So that's what I'm warning you. If people just feel this is not a so difficult course, easy, then you lose up end of the final, you're gonna be too difficult to recover. You'll lose point or you'll get a lower curve, so many things, okay? Just warning you, sometimes you treat the course as equally or difficult one and you turn out a better result. But if you treat it like this course so easy, end up ugly, you will be difficult to take care of it, okay? That's just warning you before the final because you don't want to have damage for your score or GPA. Okay, let's go back. This chapter almost done. Very, very important chapter because it's regarding banking, okay? This is banking, how they manage liquidity risk, how to manage of those adequacy on banking capital management, and bank how to manage assets, liability, all this one, we just give a simple bank example to talk about that, okay? And then we did a gap analysis on the balance sheet, and we did example a couple of times on that piece. Also important. Those are all what we mentioned in the exam, okay? Because this chapter is so important. That's why this chapter you should be inside out, understand what's going on. Now, next one is duration. We talk about a gap already, right? So now, and then we talk about basket of those group of those assets, liability match up. So match up their similar maturity, remember? So then you can sensitivity will be the similar. But then we need to talk about here is duration. Duration is very difficult concept. It's supposed to be is the bond market. When you learn bond, will be have the duration, very, very important calculation analysis, okay? But that's why in here to jump in there, but it's not that easy, okay? So what's the duration? Let me just give you some idea about duration. If we go to the bond market, you will learn how to calculate duration. But now you do not know how to calculate it. This now talk about bond market that way. So we just jump in this concept, so it will be difficult. That's why I give you some quick idea how the duration come out, okay? So that's it, is the bond, okay? Give you coupon, we learn bond from the others. And then you have principal payment. Duration definition is like this. That's it, is a coupon payment. Remember we have the coupon payment. So this is coupon payment, okay? Duration trying to say is by definition is how soon you get your money back when you buy the bond. Remember you buy the bond, you pay today. Let's say you buy at a par. You pay 1,000, and then you're going to collect a coupon payment. All right. So duration trying to say is how soon you invest $1,000, how soon you get your money back. Remember, you pay 1,000 today to buy the bond today here. You pay, you spend 1,000, but you're going to get a coupon. Let's say coupon is 100, 100, all the way. So therefore, how soon it is. That's difficult because you need a numerical calculation. But however, just follow my idea, okay? But what if this is zero coupon bond, zero? zero. You buy 1,000, or you buy the 900, whatever, the zero coupon bond. Then end of maturity, you will get a 1,000, your par value. So you get nothing until you get a 1,000 back. So this is called zero coupon bond. So if zero coupon bond, do you know what the duration is? Remember, duration definition is how soon to get your money back. So in this zero coupon bond, how soon you get it? If this, let's say this bond is maturity is a 5-year maturity. This bond, zero coupon bond, have 5 years maturity, 5 years. So how soon you get your money back? Thank you. Exactly. So that is, okay, for zero coupon bond, very easy. Duration equal to maturity. Okay, say this again. So for zero coupon bond, the duration is maturity. If 5-year maturity, 5 years, get your money, very good. But what about if this bond maturity is 5 years, but it's a coupon bond, okay? So let's say it's 10% coupon bond, doesn't matter what percentage, you don't need to calculate numerical. I just ask you a question. Say, if it's a coupon bond, coupon rate is 10%, it doesn't matter which numerical is, but the key point is coupon bond. So this is how soon you get your money back. This is coupon bond, remember, okay? You're gonna get it 1,000 back, but meanwhile, get the 10%, 10%, so $100, $100. So you think you will get your money back earlier than 5 years or later than 5 years or at 5 years?
At 5 years.
Remember, if zero coupon bond at 5 years, but you have coupon payment. So this is 100, for example, so some cash here and continue cash. So it is will be what?
So only 10 years.
No, hold on. I said 5-year maturity coupon bond this time. Remember, 5 years zero coupon bond, you will have duration is 5 years. But if 5 years maturity, the coupon bond, what do you think the duration going to be? Could it be longer than 5 years, shorter than 5 years, or equal to 5 years?
Shorter than 5 years?
Yes, thank you. So hypothetical, this duration should equal to 4. Okay, hypothetical. You're going to calculate it in the future. Advanced class on bond market, you will calculate the 4. You will get a 4.1, 4.5, whatever, but it is shorter than 5. Okay, why shorter than 5? Because you get it 100, 100 in the middle of those years, you already collect a lot of cash flow. So that's why you don't need to waiting for 5 years to will collect the money. You already get a lot of those. Remember those money you get on compounding, whatever, but you will get the money sooner than 5 years. That's why duration, coupon bond duration will lower than zero coupon bond duration, okay? Because you get the money sooner, okay?
But Professor.
Yeah.
After 4 years, wouldn't you only get $400?
No. It's not what you, it's not, I see what I mean. It's not that what I mean, okay? Let me just say this again. Duration, if you mathematically really learn that, is supposed weight average of this cash flow multiply timing. For example, this cash flow is 1 year. This is kind of multiply 2 and then divide by bond price, okay? But that's too complicated. I don't mention that. Let's just say is how soon you get your money back. So you already get a 100, 100. It's not like a 0, 0, 0. All the way at 5 years, you will get all money back, right? This if a zero coupon bond, get a 5 years to get your $1,000 back. But if it is a coupon bond, you don't have to waiting for 5 years. You can maybe 4.9, 4.8. You will, before there's so many coupon, 100, 100. Right now, let's say you have 10, 100. You already get a 1,000. Right? Imagine if a semi-annual or if this is 20 years maturity, so something like that way. So means like you will get your money sooner. I just hypothetically use 4, but maybe in this case, maybe 4.9 something, but still you don't need a 5. But if 20 years and you get it back, so that means you can, all the cash flow already collect to cover your 1,000. Hypothetical, let's say this one is 20 years maturity. What 10 period, 10 years, you already get a 1,000. Okay, the other 10 years going forward, you already have your full money come in. If it is bond, don't default. So that means you 10 years duration, you need to calculate exactly, okay? But 10 years, you already get your money back. So now that's why you know the high coupon after duration is more shorter. It's a good thing. But whole point is not here, okay? The whole point is just tell you, here is just tell you duration. We say, okay, that's what duration mean. What do you mean duration? It's with the average of time of how soon get your money back. So in this case, it's a coupon bond duration will be less than maturity. All you need to know just coupon bond duration less than the zero coupon bond duration. So you can use zero coupon bond as a benchmark. If 5 years maturity zero coupon bond duration should be 5 years because nothing there. However, if it is zero coupon bond, if it is a coupon bond maturity 5 years, and then duration will be lower, okay, smaller. But here's not the point. The point is we give you in your course, we give you numerical value of what the duration is, say equal to 4, okay? But key point is what I mean, okay? Let's go the formula. Then I'll give you again about this the calculation, okay? So here's what I say is we mentioned about this almost equal, right? So this means the market value of a security, for example, bond. You have bond, what do you change of your bond value in percentage? Okay, how you figure out your value change? So almost equal, this is equal, okay, I will show you later on, use another typing. So this sign is equal, but we can, this is PowerPoint cannot take that almost equal the sign, okay, so that's why they put empty there. So almost equal to, okay, negative percentage point of the change interest rate multiplied duration. Like last time I mentioned, let me type in the formula again, just to make sure this is very simple once you know this, okay? Let's do this one. So change it. You know what, I do this way because I cannot do that way. So change, okay, delta, change of the security price. That's a securities bond price, okay, bond, divide by the price. So that's becoming percentage. This is percentage, right? You know that. This is change of the price, multiply, divide by the price. So this is percentage price. So this bond price almost equal to negative duration, okay? This is formula. In exam, we're going to use this formula, okay? Multiply change in the interest rate. That's the interest rate is R, okay? Just use R, change interest rate. So this is a mathematical formula, okay? This is called modified duration, just use it, okay? So this is the given to your formula, but how to use it, okay? So let's do use it, do example since we're here. Let's do example. Let's say if we know from now going forward, the rest of the years, interest rate will going up 3% from here to, because today you saw this CPI already going up, right? That's hypothetical. If interest rate going up 3% means change, right? You do not know from where. It could be from 1% to 4%, but all we give you say is the change in interest rate 3%, okay? And if you know your security duration D equal to, I use 4, so let's just use 4. So if duration is 4, okay? So if like this, do you know what's your security, let's say your bond, what's your, so question will be asked you, what's the bond price change in percentage, okay? Price change in percentage, all right? So that's how duration very good. Just do it right now, then we talk about this meaning, what that mean, okay? And tell me the direction though. So I say interest going up 3% from now going forward. So it's still going up, okay? So what's your answer? Going up. What's
negative 1.2. Oh, sorry, negative 0.12.
Negative. Okay, let me do it again. So that's equal to, I type in here, okay? So equal to -4 multiplied, interest rate is 3%. So equal to -12%. Remember, it's in percentage change, okay? Percentage change. So, okay, now what do I mean? So -12%, what do I mean?
It means that the value, the present value of the bond will go down in 1 year
Yeah, down how much?
by 12%.
Exactly. That's the whole point. You see how quick it is? So that's the whole point, the beauty of the duration. So when duration is, you have to calculate all the times, okay? Because over the time going to be changed. So you're going to become, for example, bond material then becoming less 1 year material. So you have to keep up to this numerical measure, okay? So once you calculate the duration, then you immediately can forecast your portfolio or your security. In this case, your bond price. In this case, your bond price will tank 12%. So that's why you have the hedging, whatever you're going to do. That's why they have duration hedging. You have other way strategies based on the duration. Security bond market, fixed income market duration is the key. Okay, so very, very important. But here, because we need to use this concept, that's why we talk about duration. But you're going to use this formula calculator. At least you know the direction is very important. In this case, the bond, your bond price tank 12% if interest rate going up 3%, all right, in this case. But what about if interest rate, for example, from now going forward, we forecast interest rate will going down, not going up, will down 2%. Interest rate going down, okay? So now do one more time for me. Same bond, what's happening to you? If interest rate from now going forward going to drop to 2%. So what happened to your bond price change in percentage? And also have a direction. So what's that? The same formula. So duration not change, same bond you measure now, but then the interest rate changed.
It went up 8%.
Okay, so this is becoming very good. So there's 2, right? So 2.8, so that's 8. So I do this. So becoming 2 negative, okay, because it's going down. So then negative to negative is positive. So positive 8%. Good, 8%. So what I mean, how to interpret this up 8%? What I mean? So what I mean?
It means that the value, the present value will be higher of the bond in 1 year.
Yeah, increase 8%. Okay.
So I'm sorry, just to clarify, that 8%, because this number is positive, that's a good thing, right?
Oh yeah, increased. Good thing, yes. So that's why you see the bond, if interest is going down, is, remember we said the interest is always upside, right, with the bond value. So if interest is going down, price will going up, right? So your bond price will up 8%. So if you from now going forward, the forecast interest is going down 2%, your bond will be going up 8%. That's a very good deal. So that's why your duration immediately tell you how much your bond could be get higher or lower, what's the percentage very quickly, just give you the result. That's what the duration sensitivity analysis, okay, very, very good one. You can see we do both directions, calculated this, your bond security value very quickly from the duration. So duration is so important, okay? So let's go back our duration here. Remember, you have bond, your banking have the portfolio in your balance sheet, right? Banking, like I mentioned last time, have most securities is interest rate related. That's why you need to use the duration here. So So this formula is what I put that one, okay? Just use that one, be fine. But at least you can use this one quickly to understand the banking balance sheet, how quickly can be increased value or decreased value or hedge it out. Remember we did a gap analysis, hedge it out, and same logic, you can use duration hedging, okay? But at least give you how you use duration to measure. We did exercise, okay? So we done that, all the balance sheets, banking risk analysis, okay? Only a couple of things left, it is a couple of things here. Off balance sheet activity, okay? Have you heard about the off balance sheet? What do you mean off balance sheet? Have you heard about that? Okay, you never heard about that. So that's how banking is use certain things on, you know, off the balance sheet. Means not on the balance sheet, obviously cannot see it. You cannot see that JP Morgan have certain, remember your balance sheet all out there. You can looking at how assets, liability, equity, everything can see detail. They pay interest or they have a treasury bond, they have what bond, you can see it. But off balance sheet is not there. But why, first of all, let me talk about the items, and then we will talk why they're doing that, okay? Sometimes the banking, like a JP Morgan, right? You can borrow loan from JP Morgan. You do credit card, you car business, you can go to the teller window, you can do many business, that's many department, okay? But sometimes the banking do not make a loan. JP Morgan too big, they can do anything they want, okay? But of course, something the regulation don't want them. But they can do only loan service. They just collect the fee, helping the lender. For example, they have other, because they have a, JP Morgan have so many business, they can make a loan. They're going to collect a loan anyway. They're going to do loan service anyway. So then if I hire a department to do loan service, collect the JP Morgan's loan, but why we don't use same people, staff to collect some outside lenders, but we just help them collect a loan, collect the service fee. That's the XYZ lenders, but hiring JP Morgan as a collect fee service. So just pay the fees each year, each month, how much to pay JP Morgan for, they collect a loan for them, okay? Even like this loan service fee, normally this is not, is like a big deal for JP Morgan to do business. They are not really do business for service fee, but it can generate something. Those are small, tiny activities. Normally just, you know, it's not a big deal. It's not risk to them too. It's just collect a fee, right? So it means, you know, worst case collect zero, but it's nothing regarding your default risk because they're not their customer. They are not make a loan. They just collect the fees as a service fee. So that's not on the balance sheet. Okay, so that's easy to understand that, okay? So that's how some things on the balance sheet, something off balance sheet, okay? But later on, during the financial crisis, we'll mention about those. A lot of people create those SIV, structured investment vehicles, okay? So sometimes this is one pretty much like, if you heard about that financial crisis, we have CDOs, credit debt obligations, people banking doing that, but banking also do this service fee. They created this kind of separate entity, but they only do the collecting, warehousing those CDO securities, but it's not really on their book doing certain things. They just collected warehousing. So therefore, not on the balance sheet, but during financial crisis, many people didn't know it's inside so many risks. So that's another way. So SIV, okay, that's another situation. It's not on the balance sheet, okay? And a couple of things. For example, trading derivative. You heard about the banking have trading desk, like Goldman Sachs have trading desk because Goldman Sachs invest banking. They can do whatever they want, right? Goldman Sachs now invest banking different from the commercial bank. Okay, commercial bank. Remember we mentioned about all talk about loans. Okay, about the the lending. So that's becoming very, very critical to the economy. Invest banking to different thing, but regulation also differently. Okay. So JP Morgan commercial bank, but it's global bank, have everything inside too. But then their investment banking branch will subject to investment banking's regulations, but then commercial bank are subject to commercial bank regulations, okay? But they have a trading activity, they have desk trading, but normally banking, like commercial bank, forget the investment banking, okay? Because like we say, we focus on commercial bank. So commercial bank, normally if you're trading, is pretty much supposed to be for hedging purpose. Like JP Morgan have a lot of, you know, CDS, a lot of like the interest derivative, because it's for the, they have do the client service, right? But then they have exposure, they kind of hedge it out. So normally purpose for hedging. But you do know traders sit down there, never just do one thing, hedging. They also sometimes do the trading, okay? Because sometimes they do play on the trading situation. That's you heard about maybe Barron's British bank, more than 100-year-old bank, be one trader trading the future contracts, currency futures, break down the company, okay? So they do sometimes involves the trading, but however, mainly for the hedging purpose, okay? But those are supposed to be hedging purpose. Remember, if you're hedging interest rate, pretty much net out of nothing left, not that big deal. So normally it's not big size in the commercial bank book. Normally it's off. It's not big deal because not for hedging. Hedging is supposed to be eliminate risk. So that's why in general it's not on the book. So that's off. But like I just mentioned that because traders sometimes play it, so bring could be have risk. So that's why later on it cannot be all that's off the balance sheet. Okay. So that's what they're trying to tell you. Principal agent problem arise because then you hedging, then later on becoming trading, because now your company, right? So it's a shareholder company, you becoming gambling, trading, make money that way. So that's why sometimes this happen. All right. So that's off balance sheet security there. Okay. So now we're trying to mention about say, you know, you need to control. They have internal control. Internal control is called audit department. Okay, if you go to JP Morgan, they have big department called audit. That's the internal control. Then you have outside the independent third party control. Remember, they are reviewing your balance sheet. You know, they certified it. Remember, mentioned that, and they do that too. For all the public company have the third party independent auditing department outside a company. Even those company without go to public, you go to a small firm, any firm, as long as a firm, you needed to do subject to auditing. So they are control you. They will be evaluated what you're doing. Okay, make sure you do things right. If you're against the accounting law or whatever, you get trouble, right? So the last couple of pieces trying to tell you is to the banking, to the commercial bank, like we mentioned, JP Morgan, those kind of banks, those tests are very, very important. Okay, stress testing, you know, value at risk testing, and a limited on exposure means they have a limit, a ceiling. Okay, each day how much exposure you can take it. It cannot take more than that. So they have limit. Okay, trading limits, you know, the transaction limits, many exposure, they are limited, control it because for risk purpose. Okay, to manage risk. But let me ask you, anybody know what that means, stress testing? What does that mean, stress testing?
I think I know.
Okay.
So stress testing is usually conducted by the Fed, where they bring in certain models and tests to see what losses a bank could take under a certain period. And I think that's what I understand from it.
Okay. Very good. Okay, it is. So you should following the bank. You will know that the banking periodically have a stress testing because the Fed is their regulator. Fed require those banks, the member banks. Okay, say, you know, every quarter, every monthly, you need a stress testing. Means stress, just like you have stress, you stress out. Means go to extreme case scenario. For example, if we choose 2008, that means stock tank, let's say 20% in one day, and the interest rate jump to 8% spread. So certain things, all the bad worst case moment, those are parameter put in your company's, your banking's portfolio, okay? Then evaluate it. If all the worst case scenario, those parameters put in your portfolio, in your banking, this is called stress level. When you have this stress level, then they measure, see whether your stress level compared to the other bank, compare everybody else, your bank in bad shape, means like after stress out, your bank is basically bankruptcy. Remember we saw bankruptcy, just we withdraw the loan, 5 million. One bank survived, the other bank didn't survive. Just as I said, the other bank is stressed, this 5 million from the loan, and then that bank bankrupt. That bank means hypothetical stress testing out means this bank at risk, okay? So that's what I mean, stress testing. Use all the worst case scenarios, parameters, put it in your banking, calculate all your banking portfolio, see whether you can survive, whether you have risk. So then Fed know, because Fed do this test. Fed know, then Fed will be tell you the bank, you have trouble, you gotta be put in more capital or get more money, whatever you should warning you. But remember, that's why people, you know, the outside you and me, we are investor, we try to smell who is the bad one. So once the Fed stress testing result come out and say, okay, XYZ bank are not good in risk, immediately your bank stock will tank, or people just short your bank. But once everybody hunting you, your bank maybe just, you know, just like you're good bank, but suddenly you just died. Your bank collapsed because everybody hunting, shorting you or selling you, whatever, right? So that's why that news is becoming very, very secret, because cannot so easily just tell whole world, say your banking is weak now. Normally Fed will be hint or maybe give you some indication, say you are in the moment now, but we don't want the world to know about your trouble. You gotta be come up within 1 week, within 1 month, recover your balance sheet, something like that. But normally you can see, we're so quiet, we do not know who's bad, who's good, because normally Fed will give them a solution or tell them what is supposed to do, help them. But when we have bad, everything is the storm, right? If all in the worst moment that we have storm, Fed even cannot cover hiding anything for you or help you anymore, and just all information just come out, say this bank is not good, everybody gonna be shorting your bank, so you have to be quickly recover. Okay, that's a stress testing, trying to be, say, normal time, protect your go to worst. Okay, the other one is, so now you need to know those things, because when you're looking for a job, pretty much stress testing, very popular question. And then the other one is value at risk. Okay, if you learn statistics, you know this is a very simple one. But if you didn't learn statistics, okay, so that's value at risk, just one number. Okay, for example, JP Morgan CEO Jamie Dimon, long time ago after financial crisis, mentioned that, saying, hey, just value at risk, just a VAR, we call VAR. Okay, value at risk called VAR. Say just one number. Okay, it's not big, it's not big deal, it's not big. But however, it's important one, but it's not full information one, but it's one important. For example, value at risk is a statistic number. Let me just give you a quick idea. Okay, you need to learn from statistical model, but here I just give you some idea, because we are not supposed to teach VAR here, right? Just tell you what VAR is about. Normally, you learn statistics, you know, the like called the, you know, fat tail, you know, like a normal distribution. This is supposed to be normal distribution. I'm not drawing normal. Okay, I didn't do a good job, but it's supposed normal. Okay, so VAR, value at risk, they're trying to say this is, so all the most probability, let's say 90, 95, that's a 95 probability all here. Okay, that's 95. Only the tail here, it is a 5%, for example, one tail, for example. Okay, 5% probability. So normally VAR just calculate this 5% probability means 95% confidence. Okay, and then at this here, you calculate this value, the normal distribution, whatever, and then calculate this value. Let's say your VAR is like Goldman Sachs, 1 times a day. The VAR value at risk under 95 confidence interval it is 60 million a day. So that's becoming your exposure. That's your VAR number, one number, 60 million, for example, okay? So if Goldman Sachs is 60 million per day, worst case scenario, okay, because it's under 95 confidence level, how much Goldman Sachs can lose money a day, that's 60 million, just assuming that moment, okay? But if this 60 million is allowed to Goldman Sachs, means let's say if this one Goldman Sachs everyday exposure like pretty much higher and then becoming problem. Okay, so that's why they measure this one number data every day, every week, and they see what the pattern, what the trend, and see how risky if you are too high on the radar, the Fed will be noticed to you as well. But you should control yourself risk. You don't want your bank risk. So normally you will be your internal control, like I say, internal auditing, or even your risk manager or your CEO already just say this is far too high. You got to reduce the position, or your trading desk. So certain things they will be themselves will be pay attention now. Okay, so those are is risk is on the off the balance sheet. Okay, because those things is totally risk management, and also it's not really regarding the companies generate a profit, earnings, or cost. It's not like that. So that's why it's off balance sheet. It's not really for this, really for risk management. It's not really for generate profit things. Okay. So certain things are off the balance sheet. Like now you know this situation. Okay. So this is done. We done these chapters. So this chapter, like I said, very, very important. So many things here, especially for banking. Like I said, you cut the banking's balance sheet 3 pieces, right? Assets, liability, and equity. You can see each piece how they manage of the assets, the liability, the equity, adequacy, how we calculate, how we do that. So this whole chapters regarding to that. Okay, otherwise this is becoming very very important chapter, like we said. That's okay. So any question before we go next one? See here, so many management, risk management, and so otherwise we go next one. Any question? Okay, so you can, let me show you this next one. All right. Okay, so this one is like I said, it's a derivative. This whole course is touch every single little things, right? So now we touch derivatives. Remember, derivative normally will be take a whole semester learning derivative. It's not an easy one, okay? But we just use one chapter, okay? That's pretty much very intense. But here only touch couple important things linked to banking system, okay? A lot of derivative, a lot of commodities, a lot of, like I say, it's oil, you can gold, you can many derivative. It's impossible to cover everything. But here only just something related to the banking system, and we introduce a little bit. But derivative not that easy, okay? Like I said, that's I mentioned about what do you mean derivatives. Derivatives is link underlying assets. This value, this is security value deriving from underlying security. For example, options linked to stock, okay, linked to Apple stock and Apple options, right? And then you have interest rate derivative, that's linked to interest rate. So many things. So derivative it is not itself, it is underlying that security moving around, then linked to this derivative pricing moving around. Okay, so that's why becoming very complicated, because you have underneath one fundamental security moving around. Okay, but we are just give you some idea about what's the derivative, just follow. Okay, then now we can go simple, gonna go to deeper. So now let's see the hedging. First of all, here to give you some idea, say we use a derivative here, whole purpose in the banking system is for hedging. It's not for your trading, okay, for speculation, it's not. It's for your hedging. If for your hedging, okay, now first thing, let's understand what I mean hedging. Let's see what do you understand based on what do you think before I learn a course. I know this hedging is about like this. Let's see what you know about hedging.
So hedging is reducing the risk of your positions.
Okay.
So, for example, if you're a market maker company and you have to engage, you have to hold a lot of, so you have to buy and sell at any point, make the market, and this leads to you holding a lot of stock on your books. Now, you don't want to be exposed to that risk in case the stock goes in, very far in one direction. So you buy options, which, for example, if you're holding 100 stocks of Apple, you buy a put option, a contract for 100 shares. Therefore, you're hedged, meaning that when the market moves, the value of your book does not change. So it is trying to basically immunize yourself from the moves in the market.
Very good. Okay, very good. Okay, he make a very good point there too. Okay, hedging, it is trying to remove all the risk. Okay, so here's you will see is why they say this way. Say it's remove all the risk. They didn't say hedging is for make a profit. They didn't say hedging is for profit, for speculation, make money. It's for remove all the risk. That's the whole point. You will see very soon say what I mean about eliminate risk, but it's not to make a profit that way. Okay. But like hedge fund, everybody have the intuitive say, oh, hedge fund make a high return because hedge fund can hedge and long only cannot. But doesn't mean the hedge fund it is for speculation get the more return for earning. It is because they eliminate the risk. So that's why in the downside market, hedge fund should be shining, should make more money because they protect downside. You didn't, so that's why you lose a lot. But for them, they don't lose. But it doesn't mean that they want to have to be, speculated for the money, okay, for the profit. It's not that purpose, okay? So that's we will talk about hedging and speculation, total different thing. And hedging is for risk purpose, okay? Let's do this very, very soon. You will see this hedging purpose. So any transactions, any security you use, you don't have a derivative, you just choose the opposite correlation assets, long one and short one. For example, many people use the Bitcoins as inflation hedging now. Just it's a speculation, okay? Bitcoin is totally speculation because you do not know the correlation with the anything. But however, people just feel so many everything. Why don't I diversify? But sometimes if you find out exactly upside movement, you can hedging. Okay, then we'll do that more later on. But that's the method continue. So when we talk about hedging or trading, whatever, we need something. What that mean, right? For example, long position. Normally, long position means you buy. Let's say I want to buy Apple 200 shares. You just say long Apple 200 shares. That's what it means long because this is trying to say you have long, then you have short, right? So if you're selling, then you just say why you don't say buy the Apple and selling Apple. If you just buy and sell, that's so simple. Just own the share or don't own the share, right? But here's different. Here trying to say you're short. Your long position and short position means that you don't have the Apple, but I still wanted to, showing in my book is I short position. If it's selling Apple stock, is out, never showing in your book anymore, in your portfolio anymore, because you have the Apple and then you're selling it, and just say selling it. But if you want to short it, you don't have the share. That's why it's called short. So that's why booking in your portfolio, it is called short position, means you have different view. Long means you're hoping to going up, then you will make a profit. Short is even the security going down, you will make a profit. Okay, you still short the share showing you in your position, but you don't own it, you short it. Okay, so that's why we can compare whether it's your position long or short. It's not a buy and a sell. A sell is just gone, right? So that's what I mean. So that's why they're trying to use another word called long and short. If you're long, definitely have somebody short, right? Like a long Apple, somebody will be short Apple, okay? So that's the word, okay? So hedging risk. So involved engaging in financial transactions, you have to use something to hedging. Okay, so you need financial transactions, all right, to offset your position. So offset means if you have a long position, let's say you have, I have 100 shares of Apple stock. I have it already. So I wanted to hedging it. So I will take an upside position. That's what it said, offset your long position. So I long already. So I offset, I should short. Okay, that's what I mean. You offshore short. Okay. So like he just mentioned about the buy put, we will talk about very soon about the put options. A put option is just do the job about your short, but you long the put, actually you're short. We'll talk about that very soon. But the whole point is the hedging is to take an upside position. But what if I short Apple already? So I want to hedge my short position, I can long Apple. That's what they're trying to say. Offset your position, okay? So that's offset long position. So that depends on what you have it. You have a long position, you take an offset position to hedge it. Or if you have short position, you take a long position to hedge it. That's what they here trying to say is upside. Okay, offset your position. That's your hedging there. So then remove our risk. So if market go to one direction, you have the other position too. So can cancel out the risk. That's what I mean. But we don't want to talking. Hedging things is not talking. We will see very quickly about example how they hedging and how the derivative works. Okay, very soon we go there. So that's the basic, like we mentioned there, hedging. Okay, and you have long position, you have short position. Then you take the upside position if you already have something. Okay, so that's we did that one. So now we talk about quickly jumping in is banking securities, right? Remember banking have interest rate sensitive security. But basically banking have all its securities, assets, loans linked to interest rate. Okay, that's why interest rate forward contracts becoming so important. Okay. So what I mean, remember this is a forward contract. Everything forward means in the future, okay? What's going to happen in the future from now? Okay, so that's what I mean. So forward is agreement, normally called forward agreement. So if it's agreement, that means you and me agree. Okay, that's what I mean. Agreement means you and me. So we can negotiate. Even you and me agreement, easy, right? I just tell you, hey, I want this term. Hey, I want that interest rate. I want $5,000 to do this interest rate. So many things you and me, we can talk about, negotiate. That's what I mean of agreement, okay? So you will see why they said this way, because very soon we're going to see the future market is different. It's not like agreement anymore, okay? So let's see. So forward contract is agreement, forward agreement, okay? That's what we normally say. So agreed by two-party or three-party triangle that way negotiated. So normally agreed by the parties to engage in financial transactions. For example, you and me will agree about the currency swap or interest rate. You pay me floating rate, say LIBOR plus 5%. I pay you coupon bond, coupon fixed rate, right? So you and me agree, and then we're done. All right. So then we talk about which days and next year 2022 and product we just mentioned about that. So everything you already point out by then we just finish the term, right? So that's how simple it is. That's it is, right? So linked to financial transactions, referring the future, what time, and we talk what's the product already. You and me agree. So that's agreement, okay? So it's agreement of forward contract, okay? So next one. So specific of the actual debt instrument, like I said, you and me agree, you pay me LIBOR plus 5%, I pay you US Treasury security, 10 years material, certain things before, because you don't want to go to legal lawsuit. Tomorrow I lose money, I sue you. You didn't say clearly about which one, right? So therefore, you and me agree, very, very clear contract, say what time, what's the product, specifically. Remember, this is regarding to legal lawsuit, because once people lose money, people lose everything, attitude, whatever, you know, so that's why you have to be clear to say it, okay? So let's specify everything. Product, you know, future dates, which days, what's the, you know, assets going to deliver. Okay, by then, let's say 2022 on March 31st or March 10th or March 1st, you're going to give me treasury security. I'm going to give you LIBOR, blah, 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 like that. Very clear. Okay, so that's one thing. So amount of the debt instrument to be delivered. So like I said, right, it's $5,000 or 500 millions, clear. So like I said, it's a contract agreement, is legal term actually. If something wrong, normally you have to be clear. If you don't clear, it's very easy to get lawsuit, especially if people lose money, people desperately wanted to sue you, okay? So that's the clear. So price, if it's interest rate swap, definitely you mentioned right now, right at the moment when you enter the agreement, mention about what interest rate. You're gonna pay me 5% plus LIBOR. Okay, that's what we say. And then I will pay you 10% or 5% coupon bond, coupon rate. And that's already fixed so forever until this term mature. So very clearly indicated what the price it is, right? So that's interest rate. So that's the agreement and deliver based on that. So date on which delivery will take place, right? So which date, like I said, March 1st or March 30th, whichever. So very clear, you can see, okay? So that's agreement contract. So that's the, but referring to forward in the future, what you're going to give to me. So that's why it's called forward contract. So very simple, but banking do this a lot because banking needed those things, okay? So, however, like I said, it's you and me a negotiator, so that's why I have pro and the cons, right, for forward contract. So because you and me can be negotiated, it's flexible. Just you and me agree, that'd be fine, as long as the term are clear. So that's why we can be flexible. We can choose March 1st or March 1st week, right? So we can choose LIBOR or can choose a Fed fund rate and choose something. You see everything you can be, as long as you and me happy, we done this one. Okay, so flexible. But you can see, I wanted to, let's say I do this whole thing, I wanted to have a LIBOR plus 5%. Now I have to find somebody who wanted to, with me, do this interest rate forward, give me the LIBOR plus 5. Okay, 5%. Although, like I said, flexible, but I had to find out the other person like it. I had looking for, because this is just me and the other party. So you needed somebody help you find out the other party. So counterparty, the other party's counterparty. You had to exactly find that counterparty who wanted to give me the LIBOR. Maybe the other party have the Fed fund rate, or many people have different things. I had to find out precisely the LIBOR, okay? So that's difficult. You do not know who. You need some maybe broker. That's why you have broker, right? Have something else, somebody else can help you. It's difficult. Okay, you will compare very soon, go to the future market. You don't need this. So that's why this forward contract, it is difficult, is to have a find a counterparty. But if you find a counterparty, you finally find out this party in New Jersey, and they can do this for me, but you're only dealing with that counterparty in New Jersey, like that company. So then that company can be anything, can be disappeared, can be default, can be anything. Nobody care, only you care because you have deal with this company. So you have a default. You're facing default risk from your counterparty because just you and the other party. Okay, so you're responsible for your own business. So that's why it's bad. Bad means flexible is a good thing, but the bad it is you have to find out that company, make sure the company do not default. You have worry about this company's survival or good business or not. So that's another bit that you have to take care of because nobody else have business with that company you are. So you have to be careful. So that's the flexible is a good thing, but then those others in counterparty difficult means illiquid. Okay, so I find out. And then also find out that counterparty, but you could be facing default risk because that's you facing it. The company can be, any company can be the problem, okay? So that's the another thing you need to think about, this interest rate forward, good and bad, okay? So now easy for you to figure out this idea. Okay, so see, now we jump into future contract. You heard about a future market. I won't talk that much. Let's just give you a future market story. Okay, if you go to supermarket, you see apple. Okay, you see apple bigger size. Each size, you see why apple, they all in the same size for this price, and the smaller one for the other price, and for a bigger one. So each items in the future market, they did a well-organized commodity market. Okay, commodity, they all trading on the future market. You think a farmer just go to the from the farmhouses go to the market selling, and then you go to farm market buying, right? So otherwise, they deliver from future market. Future market, they standardize, say this apple, bigger apple, good one is grade 1, and the grade 2, grade 3, grade 5. Give label it. Then in the market, they say, okay, grade 1 trading at let's say $2 per pound. And then grade 2 trading at, let's say, $1 per pound. So they give certain ideas, they give certain labels. The commodity future market is very good organized, okay? It's the markets. Okay, so we will talk about it. Then you're going to compare with market, future markets, or just agreement. Before that one, we just did a couple slides. That one is interest rate forward agreement, just two party. This is not two party, it's a market, huge commodity market, selling apple, oranges, oil, corns, everything. Okay, then but the character, each quality, everything have price label. Okay, that's why your farm supermarket buy food, why so standardized, because they coming from there. That's why price different too, each quality different too. Okay, so we go to future. Let's go to future. It's a market, the first thing you know. Okay, so similar to interest rate forward contract, but different. Okay, in ways that overcoming some of liquidity and defaults problem. Why? Because they are market. It's not the other counterparty anymore. So if you go to future market doing interest rate security trading, you're trading with the market, not single one person. Have a lot of people that are trading. So means very quickly, I want the LIBOR plus 5%. You're looking at the LIBOR, looking at the market, a lot of people there offering, selling. So it's a market, like I said, market is huge, okay, huge. So you don't have that liquidity problem anymore. So there's more liquid, many people, whole world coming. The whole point is just like your in your connections, internet, become we suddenly connect to the whole world. So whole world could be always have somebody this, that, so that a lot of people want trading that. So that's liquidity, okay? You have no problem on liquidity now. So default problem. You don't need to bother about who is the seller, who do this LIBOR plus 5%. You don't need the counterparty anymore. So that's why you don't worry about who is there. It's a market there, a market control. If something wrong, market will be take care. Remember, you have margin call, you have everything. They take care of the other party have trouble. Now you don't need to worry. You're trading with the market, okay? So that's another thing, is it has huge future market. This future market, like I gave you example, is commodity because easy to understand. Future market have everything. So that's why they have interest rate securities. For example, interest security, for example, treasury. A lot of treasury in the future market, okay? In the future market, trading on US treasury security bond. That's linked interest rate. So that's why many, so just don't worry about that. So that's a relative solve the problem. What are we concerned? One is cannot find a counterparty to trade. The other one is the counterparty could default. Now this all is gone. You don't need to worry about anymore, right? Because market take care of it. So at the expiration date of the future contracts, the price of the contract converging to the price of underlying assets. So what that mean, okay? Because let's say you have right now it's a future contract. Let's say right now it's April. So you buy, let's say you do treasury, okay? You buy the treasury future contract right now for maturity next year on April. So each day going by, this future contract going to close to the maturity. So by end to next year, April, going to be matured. That moment, the price, that's 1 day before that maturity on next year, April. And then the treasury security trading will close to the maturity date that moment, because they already almost mature. Next day will mature. So that's why converging to the same price. Let me say it again, okay? It's difficult. If you see the market, maybe easy. That means hopefully I can do that, okay? So the market, okay? In the market, they have list, okay? In the market, just like a stock or options, you know that. So have lists. So then this, so security one, for example, H1, and then you have security two. So different kind of treasury bond list there, okay? But then that said, this is a 10-year maturity. Just something I just gave you. Actually, you know, I think I have table, but I don't want it to open up right now. Just 10-year maturity bond, but they tell you what's the price right now. Let's say it's trading at just hypothetical, okay, not 900 per, but the face value is 1,000. Or just hypothetical, okay. Just trading right now, but the maturity is 1 year later. So this are just basically a label. Say what's this bond look like, and then trading the price, okay. And then this tell you in the market they have list, okay. This is a list and tell you the price and the maturity. So then your maturity say here's 1 year, 1 year, okay? So now today we introduced right now 790, okay? So then tomorrow is not 1 year anymore, and then end of this year, half a year's over, but then this price 900 keep close to maturity. They're gonna fluctuate it, but close to maturity. But remember, this maturity gonna be 1,000, all right? So then 1 year, next year, this time, just 1 day left. So this treasury, this is future contract that should be trading at, let's say it is 990, okay? Because it's close to mature going to be 1,000 par, right? So the close there, and then this 1 day left. So next day will be 1,000 par. So that's why this converging, this security moving too close to itself value. Okay, because remember time value. So this is close there, already know. So every day this future market price is going to be quoted, but each day quoted to tell you this future market converging to the true value of this security. That's what I mean, okay? Because this contract linked to that underlying security maturity there, okay? So that's what I mean. So eventually you will learn more in the future market or derivative, but here just use one sentence to tell you how the moving progress about this converging, okay? So future should be converging. You will learn that, you have some base risk or whatever, but at least you know over the time they will converge to exactly that security value, okay? So once they close to there. So this gives some idea about the future price movement, but hopefully you get some idea. But if now they ask me a question, right? So now we're gonna go to very important one. I won't talk more about this. I repeat this next time too. This is very important and will in exam. But you understand this one is good. You will understand this one. You pretty much know what I mean hedging, okay? Just follow me. This is a difficult one if you never learned derivative, okay? But if follow me, you will be okay, have common sense here. So application trying to tell you the example, right? So hedging with financial futures. So we want to use a future hedging, okay, just watching out. So what I mean, remember we said you're hedging, you need to take an upside position to offset your risk. So that's say you're already holding $5 million bond, okay? Why I know it's bond? Because they tell you 6S means 6% coupon. That's how bond, the simple code, okay? So 6% coupon bond, maturity is 2020, okay? So you have this bond. Remember, if you have it, that means you long this bond already. So if you're hedging, you should short, okay? So that's what we're gonna do, okay? So first story is you have this much, $5 million bond. This bond coupon payment is 6%, maturity 2030, okay? So that's only the story we know now, all right? So now next one. So March 2013, 6% coupon of 2020 maturity line bond on March, okay, on March 2013, assuming it's today. Okay, assuming it's today. Today is March 2013. This bond, a long-term bond to be delivered in Chicago Board Trading. Okay, that's the commodity. Okay, Chicago commodity, that's the trading future contract expire in 1 year. So then that means 1 year later, so 2014 on March. Okay, normally the quoting on is based on months, which months deliver. So then they choose, they all know which they deliver, okay? So 1 year, you can see that you have, this is, let's say it's what, 30-year maturity, or that's in this case, if today's is 2013, this bond have a 17 year left, okay? So 17-year maturity bond, you only want the hedging 1 year, okay? So you just care about the next year, from now to next year, March 14, okay? So you have the bond, you know the direction right now is take upside, okay? So that's the one thing. So, okay, so on March 2013, that day, so you have the bond and then this long-term bond to deliver in this, which exchange you know now, and they're going to expire in 1 year, which you know in the future, which day, that's why I call future, right? So it's 1 year later, you just had 1 year watching. So this is so far you understand now, okay? So paragraph to paragraph, okay? So next one, what I'm trying to say is, okay, interest rate. Okay, let me ask you again, okay? Interest rate is back to stay at 6% next year. Okay, so what that mean? That means this bond is selling at the par, right? Because the interest rate, the bond coupon is 6%. Interest is back to stay at 6% for next year. Okay, so the 6% coupon bond of this 2030, this bond character, right? So the bond is matured down. So this bond under the future contract are selling at a par. I hope you understand line by line, okay? Do you understand this, what I mean? Because if they tell you during this year, the interest rate stay at 6%, but this bond coupon is 6%. So during this year, the bond will be selling at the par. You okay so far on this piece?
Yes.
Okay, good. Then follow me. Okay, good. This year we didn't change anything. So that means the price do not change. Great. Okay, let's see. Needed to offset. So that means, remember, we needed to take upside position. So we offset, but we have long position. That's why we need a short. Okay, so that's another line. So needed to offset the long position in the bond with a short position. So this also easy to understand because we said that. We said if you have long position, you should take an upside position, offset, so that you can hedge it. So offset the long position, we have the bond, that means we long the bond already. So we should be short. So that's short position, very good. So this line we also clear. Okay, so far half of this one you clear now. Now follow me. If interest rate increase over next year, remember we say we assuming it's 6% for the next year. So we are assuming that moment at the beginning, it is 6% and coupon 6%. We okay at the beginning when we enter the contract, okay? Then over this year, things changed. But we did hedge it, remember, we take a hedge position here. So let's see what happened, okay? Because the interest rate increased, okay? Remember, so from here, you need to know, before interest 6%, and the bond is selling at the par because coupon is 6%. But now interest is going up to 8%. First of all, you tell me, follow me, okay? What's your bond price? Don't give me exact number, just tell me direction. You have $5 million bond, interest at 6%, so the bond still maintain $5 million. But now interest going up 8%. So your bond will be gain or loss?
Gain.
Why you gain? Interest is going up.
Loss.
Yes, remember, okay, remember we learned interest rate movement and the bond price movement have an inverse relationship. So if interest is going up, bond price will going down. So in this case, interest going up 8%, bond price should going down. You agree? Bonds are going down, right?
Yeah.
Oh, okay, good, follow. Okay, so bond price will drop, so will be below 5 million because your par is, remember par is 1,000, but you have many bond, right? So that's why total is 5 million. Okay, watching. So we almost done there, okay? I won't go far than this slide today, and then we're going down. So watching. So value on March 14, right? So next year, because interest rate during this period is going up to 8%. So therefore your bond value lower. So they calculate for you. You don't need to bother about this. It's just no direction. So you should be lower. So that's why around the 4 million. All right, around my 4 million. So your bond value dropped, okay? Because interest going up. If you don't do the hedging, you bond right now worth 4 million. Okay. But before you bond is 5 million, but right now you really have only 4 million right now. So you lose the value. If you don't hedge it, you lose 1 million almost, right? Okay. So, but we say is you did hedge it, okay? What do you hedge it? You take the short position. So at that moment when you're short, right, in the beginning is setting it apart, you short one year period. You short at a par. Remember, you take an upside position. So you're short at 5 million. All right. So when interest is going up, the bond price going down, doesn't matter because you short 5 million. The net result is watching you short 5 million. But I will mention shorter piece on the other side. Okay, here trying to show you is that you have 5 million, but now becoming 4 million. Your loss is almost 1 million. They didn't talk about the hedging that piece yet. Okay, here just tell you your net result from your bond piece, not hedging yet. From your bond piece, you right now lose money. You lose $960,000. You agree here so far? You okay here? Are we okay here? Do you have question here? I'm not going to be next page because the next page will be next time when we come back. But I want you to know, do you understand this piece? We confused here?
Professor, are you going to go over this again next lecture?
Yeah, we will. Yes, because this
awesome.
is a very, very important piece. But I wanted you to ask me a question though, where we got lost. I'll do here line by line, right? You're all okay on line by line, each one, which is within these slides, any question, I have 2 minutes, any question pop in. So we're going to talk about this again. And this is in the exam anyway. So that's why I wanted you to pay attention here. So what's the question here? Where's the confused?
You should show the calculation.
I show the calculation, you guys do it very easy. Okay, first of all, how we got 4 million? Remember, you have interest rate 8%, right? And bond is what, 20, so 17 maturity. So that's those things we know how to calculate bond price. So we just say, okay, you know interest going up, bond price dropped. Now you can drop say 4,050,000, but now just give you exactly to save your life. You can do it. You guys do it. Here's again, you have the bond coupon, you have a maturity. Today is 2013. Okay. So you input, you should be around this level. Okay. Why is around? Because you March to March, that means the maturity months, you're going to be under you learn bond, you know, to take accrue interest things. So you don't need to worry about that piece. Just that's why they give you the bond price. If you're curious, you just input, you use the calculator like we did it before, right? So you input the 17, here's the 17 years maturity, coupon is 6. They didn't even mention about semi-annual coupon. So just assuming annually, and then interest rate at 8% was the price, at the 6% is at a par, so you don't have a problem. So we'll talk about this next time. And so now we just want to mention that you're going to go to derivative a little bit twist, okay? Next test is the final. What the chapter covered? You go to the syllabus, okay? We will mention, but I will make an announcement when I know the detail about the final exam. But right now, so far, it's like temporary. The school tell us it's on the May 20th for your course at the 3:30 p.m. And chapters, which one it is on your syllabus. So pretty much like what do we have? 8, 9, 10, and 14, 16, 17, 18. Okay, so that's what it basically, but you verify from the PowerPoint, okay, from the syllabus. And so, but like I said, your participation is on the June. Okay, I have recorded. So those records are very important for me. When you score so close to each other, then your participation becoming very important. Okay, and it is good course, a very interesting one. It should be have fun, enjoyed, or whatever. But however, for the final, it's becoming your GPA. You don't want to hurt it. Okay, I can mention that. Okay, so what I want.